Ladies and gentlemen, welcome back to the channel. My name is Julius and I'm watching the best videos of the trading industry, so you don't have to. Today we are reacting on I Coded TJR Trading Strategy. Does it work? By Revello Trading. So he's basically backtesting TJR's trading strategy, and I saved that video for later. When you see it, it's already a couple of days old, which is no problem. I do not want to steal views from the original creators, so we're gonna leave a like and let's get in for a very interesting video. Probably you guys leave a sub down below real quick, and now let's watch the video together. Here we go.
If you are a trader, you've probably watched at least one of TJR's videos.
We did that together already.
One of the most,
and also the exposed video from Iman Trading. Okay, so I don't know if TJR is legit. Let's see if his execution, if his strategy is really based on fundamental profitable data.
Watched smart money traders on YouTube right now. But have you ever wondered if his strategy actually makes money? Well, me too. So I did the unhealthy thing and watched 293 of his...
Is that even possible? Those videos are well above half an hour long each video. So, God, this is hours of trading material.
His videos. 136 hours, 20
what I was talking about.
minutes, and 35 seconds. Then I turned everything into over 10,000 lines of code to answer a simple question. Does his strategy actually work? Before we test it,
this is exceptional dedication to a topic.
we need to understand why this setup became so popular. Because on a finished chart, it looks almost perfect.
Make it a little
Price is
faster.
in an uptrend. When it breaks the previous high, new traders jump in with buy orders. Big institutions need massive volume to fill their positions, so they use all these new buy orders as fuel to open their shorts, driving the price down. The breakout fails, and a few candlesticks later, price breaks structure in the opposite direction. The story is clear. Big institutions trapped buyers, swept liquidity, and the trend reversed.
But this isn't always the case. Sometimes a breakout in a perfectly uptrend works. Look at this example here. So it's not that easy to say, okay, every time the breakout occurs, the institutions will sell.
Then price pulls back into a fair value gap, an order block, or an equilibrium zone, and that becomes the entry. The exact same logic works in reverse during a downtrend. Liquidity sweep, break of structure, retracement, and boom. It looks logical. It looks repeatable. But there is a huge difference between a story that seems to make sense and a strategy being profitable. So I watched the videos from one of the most watched smart money traders, TJR. But the more I watched his videos, the more I realized something I didn't expect. The rules don't fit together.
And there's a lack of buy orders. So what is price going to want to do to this imbalanced price action? It's going to want to balance it back out, fill in that imbalanced price action, fill more sell orders, so price can what? Move further to the downside. Plain and simple.
Liquidity, fair value gap within here, liquidity. Everything gets hit.
Time to put your trader's cap on for a second. Did you catch the inconsistency? In one video, he explains that a fair value gap is a zone the market respects and doesn't break very easily. In another video, he places a take profit on the far side of a fair value gap, as if price will easily move straight through it. And of course, it does, since the trade is taken in hindsight. This wasn't the only contradiction.
Okay, but trades taken in hindsight with like back testing in a situation where you're able to see the full chart. Guys, what is that? That has like nothing to do with real back testing. Okay, back testing needs to be done in a semi-live environment. So in a situation where you're not able to see how the chart eventually turned out. Because otherwise your mind will easily play tricks with you. So that you say, okay, I would have taken that like this and like that. So in the end, it would have turned out profitable. Only because in the back of your head, your mind already saw how the trade turned out and is playing tricks on you.
Others, and this is a common hidden safety net of discretionary trading. If you win, you applied the strategy correctly. If you lose, you applied the wrong version. Either way, the strategy is never wrong. Only the trader is. Contradictions weren't the only problem. Some of his rules aren't really rules at all. They're assumptions. For example, here TJR marks all the swing points on the chart. But why didn't he pick this swing high? Or this one? Or this swing low? They look just as valid. How do I decide how many candles to look left and right before something counts as a swing high? 6 candles back, 2 forward, 8 and 4, 12 and 6? Each choice...
Well, what you could do in a situation like this is measure the amount of percentage that this first retracement did, and it seems like it's easily been doing 75% retracement. Okay, let's say I don't know why I'm trying to defend here or something, but I want to just share my charting abilities. Okay, if this is the first push, short push, then we could say that this is at least 75% retracement, okay? And then we could argue, okay, this is another big push here, obvious. As soon as we are in this long retracement, you can say, okay, now we again want to see somewhat of at least 75% retracement. And then this swing high is probably still too low. Okay, and this is what I'm immediately telling here. You can use those little measurement tools.
It changes the trades. Here's what that looks like in practice. With 6 candles back and 2 forward, this is a swing high, the highest point in its range. Change the definition to 12 and 4, and the same candle is no longer a swing high. So if we choose tight parameters like 2 and 1, we catch every wiggle and flood the chart with noise. If we choose loose parameters like 20 and 10, we only mark the major turns, but miss real setups in between. And that was only one of the concepts to code. Every other piece of the strategy needed the same treatment. And little did I know it would take me more than 10,000 lines of code to replicate every single nuance.
There's a difference between a really only mechanical setup, which I'm still a big fan of, and I'm certain that there are mechanical setups that work perfectly fine, but at the end, as he told you, you're gonna miss a lot of opportunities, and some opportunities just don't work out. But for automation of a setup, a mechanical approach is always the better choice. If you want to just be a really good trader on your own without mechanical approaches, without expert advisors trading for you, then you cannot put those rules into such a fixed environment where everything has specifically entry rules like 20 or 10 bars. It doesn't work like that, okay? Then you have to rely on your experience and education and what you really see and feel in the market to execute something, which is way more dangerous, but in the end you can definitely take more setups and maybe even have a higher win rate than with a mechanical approach, okay? But you're still open to a lot of failures, while a mechanical approach with fixed rules doesn't make those human mistakes.
Of TJR's trading strategy. But when I was done, the strategy wasn't a few rules on a chart
I'm
anymore.
a little overexposed here with the lighting. I don't know, it's a really bright day today. And with my little softbox here, I get a little too overexposed. Hopefully you don't mind. Just take it as I'm enlightened by all of my trading abilities. Okay, let's continue.
It was a system that replicated TJR's trading framework, exactly the way he teaches it. Throughout his bootcamps, TJR makes one thing clear. A liquidity sweep followed by a break of structure is already a complete valid signal. You don't have to wait for anything else. So that's where I started. Version 1, the simplest version of the strategy. Sweep, break, enter. Stop loss goes just beyond the wick of the liquidity sweep. Take profit is split into 3 parts. Each part is placed at a previous important level of the market, but with a minimum risk to reward ratio of 1:1 for TP1, 1:2 for TP2, and 1:3.
I'm not the biggest fan of splitting up your take profit, actually. To be honest, I'm not a big fan of that. I would rather add at those specific marks. If I'm really sure that the market can go higher, I would add here, and take profit here, with the, of course, risk that everything will turn out break even or with a loss. Otherwise, I would just take the full position out here. So I have to make the decision, do I think that the market will break higher because of liquidity, because of the volatility, the speed of the market, whatsoever? Then I will add. Otherwise, I would just take my take profit fully here at this level. Of course, only if I trade by myself and without my specific mechanical approach, and this everything will be based on specific rules, so I do not have to make a decision.
For TP3. Price hits take profit 1. A third of the position closes and the stop loss slides to break even. From that point on, you are trading risk-free. The trade can't lose money. Take profit 2 hit, another third out. Take profit 3 hit, the trade closes. Then I set risk per trade at 1% of equity, and only 1 trade per pair can be open at a time. Also, to prevent taking trades...
Okay, first of all, good to know that we are talking about Forex pairs here, okay?
When the market is barely moving, I built session and volatility filters to skip the quiet hours and dead markets. I tested this on 4 currency pairs: Euro-dollar, Pound-dollar, Dollar-Japanese-yen, and Pound-Japanese-yen. 3 timeframes: 5-minute, 15-minute, and 1 hour. From January 2016 to May 2026. 12 markets, more than 10 years. 2 final details before the results for version 1. Remember the headache from earlier about swing points? I solved it by testing several reasonable values and used the one that gave the strategy its best overall results. Yes.
Okay, we probably all know that he used a lot of AI to get all of the coding done and those little ranges that fit best, probably used Claude or whatsoever. But this is the great time that we are living in. We can use those tools to make such a video possible.
This is
I'm not 100% sure. Maybe he did all of that on his own, but chances are high in today's world that he used a lot of AI to help him.
technically called in-sample optimization, a form of overfitting. I gave the strategy the most favorable version of itself, on purpose. If it doesn't work even with that advantage, then the answer is simply that the strategy doesn't work. And I also removed all transaction costs. No spreads, no commissions, no slippage. The results you're about to see are not pessimistic. They are the best case. So, with everything set, I ran the test for version 1. Python is great for running the analysis, but the raw output is quite ugly, so I rebuilt the results into a table. The average return across all 12 combinations was 20.13% over 10 years, so the strategy was profitable. But 20% over 10 years isn't great when the S&P 500 returned 306% in the same period. And even our best performer, pound dollar on the 15-minute time frame, returned only 115.7% over the decade, slightly more than a third of what the index returned by doing nothing. Honestly, we don't even need to bring the S&P into this. 20% over 10 years is about 1.8% per year, which in some countries is less than what your savings account pays you.
Okay, several thoughts on that. First of all, of course, if this is the return, it doesn't make any sense to do that because you put a lot of work into it. Nobody's working for 1% a year, okay? At least not in the trading industry. So, on the other hand, markets change over time. So what works in 2016 might not work as good in 2026. But I think if TJR would look at that, he would say, okay, you need a little bit of personal filters in each setup, to your own human touch on each setup to filter out if it's worth taking or not. You probably, which is now the case, cannot put this strategy into a mechanical setup that will be executed automatically. Of course, this is not working.
But V1 starts to give us some clues to work with. First of all, the 15-minute time frame looks like the sweet spot. Less noise than the 5-minute, but still enough setups to generate opportunities. In our first test, it clearly outperformed the other timeframes. Also, the strategy seemed to prefer pairs with stronger directional movement, while Euro-Dollar was the clear weak spot. Another interesting thing to notice is the hit rate of the take profits. Take profit 3 was hit only 17.6% of the time. So, while it is true that take
Totally normal, okay? A larger move happens less likely than a smaller move.
profit 3 gives you a very good risk-to-reward ratio, it is also true that the win rate using take profit 3 drops drastically. And this is something I want to spend some time on, because I think you can significantly improve your trading results by understanding this concept. Splitting a trade into several take profits and moving the stop to break even after take profit 1 is the structure TJR teaches, and that hundreds of YouTubers endorse. It sounds smart until you backtest it. And most of them never backtest it. So here is Revello Trading doing the work for
This is what I was talking about at the beginning. I'm not a big fan of that. I would not do that. Now, I've never backtested this specific way of taking profit myself, but now Revello Trading is doing it. So let's take a look if my feeling is right and this actually does not make a lot of sense.
for you. This is a risk-to-reward calculator I built, so we can follow the math behind this concept in a simple way. Imagine a trade where you risk 1R. You place your first take profit at plus 1R, your second take profit at plus 2R, and your third take profit at plus 3R. You may think you have divided your trade cleanly into a 1-to-1, 1-to-2, and 1-to-3 risk-to-reward ratio. Wrong. When TP1 hits, you only close a third of the position, so you walk away with 0.33R. But when the stop loss hits, you lose the full position. That's minus 1R. If TP2 also hits, you might think you've added another 2R. But again, you only closed a third of the position, so you actually added 0.67R. Combined with the 0.33R from TP1, that's a total of 1R on the trade. All this work, 2 take profits hit, and you've made the same amount you would lose from just 1 stop loss. Finally, if all 3 take profits hit, the trade closes at plus 2R total. Just double the risk. That's the absolute best case. And remember, only 17.6% of trades got there in our first test. This is one of the painful realities of partial scaling. It reduces emotional pressure. It makes the trade feel safer. But unless enough trades reach the final target, it can quietly damage the payoff structure. Even if you increase TP3 to 10R, for example, trying to hit the jackpot, your entire trade will close with a risk-to-reward ratio of 1 to 4.34. Yeah, 4.34R sounds good, but remember that your trade has to travel 10 times the distance of your stop loss to capture that reward. Realistically, you are not going to hit that take profit very often. While every loss will still eat an entire 1R, this tells us that already a better version of this strategy could be achieved by revisiting the take profit structure. But for now, I just want to present the results of the original strategy. We will have time to discuss what I did to improve the results and how you can apply the same concepts and findings to your own trading. Overall, version
Okay, so we actually got the improved versions from TJR Strategies here for free. We don't even need to do the TJR bootcamp because this is the improved version here for free. Incredible value.
1 is not worthless. It found some positive areas to work on, but as a broad strategy, the performance is weak. But let's not get discouraged, because we still have not added some pieces that form the complete strategy TJR uses. The next step I took was to add the daily and weekly bias. The rule TJR teaches is simple. Don't take a trade unless the daily and weekly charts are aligned with the direction you want to trade. So for long positions, both daily and weekly must be in an uptrend. For short positions, both must be in a downtrend. If they disagree, we skip the trade. So I built the
Too many filters at the end will stop you from trading profitably because you have to just filter out too many profitable trades. And in the end, you're going to do 1 or 2 trades a week. Probably this is not going to satisfy you if you really want to spend like a specific amount of time each day in front of the trading desk. That the daily and the weekly will be on the same side is not happening every day. So this alone filters out a lot of maybe profitable results.
filter, optimized the swing point parameters for this new version, ran the test, and compared the results to V1. Well, adding the daily and weekly bias filter made the strategy noticeably worse. The average return dropped from...
Is this his actual voice or is this a really good AI voice? Because he's like, if this is the actual voice, he's made for such content, okay? He's made for explaining stuff because this actually sounds really, really good.
20.13% to 7.85%. 9 of the 12 combinations got worse. Only 3 improved, although pound Japanese yen had a significant boost. Overall, higher time frame bias made the strategy worse, not better. This is a key finding. And once you look at why, it actually makes sense. Quick question for you. What would you say about this chart? Uptrend, downtrend, or neutral? I'd say downtrend, and I'd guess most of you would say the same. Now, what about this one? Strong uptrend, right? Both of these are Euro-Australian dollar. The chart on the left is the weekly. The chart on the right is the 5-minute. And here's the thing. Everything you see in that 5-minute chart happened inside just 2 candles on the weekly. For 2 entire weeks, the bias filter would have told you to look only for short trades.
Yeah, this is what I was talking about, okay? It will filter out so many profitable setups here. This is not working with the weekly. In the weekly, this is gonna get exhausted real fast. And if you are searching for short trades here, you will have no chance.
And not only would most of those short trades have lost money, you would have missed every long opportunity that actually worked and made money. The lesson isn't necessarily that higher time frame bias is useless. The lesson is that time frame distance matters. A weekly chart and a 5-minute chart are just too far apart, and if your filter is too far away from your execution time frame, it may not improve your trades. So V1 isn't helped by adding higher time frame bias, but there's still one major piece of the strategy we haven't tested, the retracement entry. The part where TJR tells you to wait for price to pull back into a fair value gap, an order block, or an equilibrium zone before entering. That's version 2, and that's what we're going to test next. So in version 2, the first part of the strategy is the same. We wait for a liquidity sweep, then a break of structure. But instead of entering right away, we wait for price to retrace into a fair value gap or...
Waiting for a retracement can significantly boost your profitability, but still patience is a big factor in that. I don't know if you're able to always wait for a retracement because they will not always come. They come maybe 1 out of 3 times if you're lucky. And that will also filter out a lot of profitable setups. So this is a patience thing.
An order block. And equilibrium acts as a filter. We only take trades retracing past the 50% mark, where price is in a discount for long positions or a premium for short positions. The expectation was simple: better entries, better results.
Again, in this example, I'm not a smart money concept trader. I would want to trade, let's take only a look until this point here from the start. I would just immediately, if I can only take a look at this short extraction of the market, I would see, okay, we are in a short trend. Let me make that in a bright green. We are in a short trend. Now we were tracing maybe to, again here, a little above the 50% line. And now we seem to continue short. So maybe I would want to search for short trades after a breakout lower of this bullish candle here. And then just hold all of that until we are more or less back at the lows, okay? So I would rather trade this movement, this movement here, than trying to go long. Good, enough technical analysis.
But that is not what happened. V2 gave an average return of 4.23% over 10 years. Only 6 out of 12 combinations were profitable. Version 2 performed substantially worse than the simple sweep and break we tested in version 1. If we check results by timeframes, once again, the 15-minute timeframe outperformed the others. If we check results by currency pair, we find that euro-dollar was yet again the weak asset. Another very interesting observation concerns the entry type. TJR teaches that the more confluence on an entry, the better the trade. But the data shows the opposite.
Okay.
Order block trades carried the entire V2 strategy. They generated 142 R of profit across the test. Fair value gap trades lost 40 R. And the trades with both signals together, what TJR calls high confluence setups, lost even more.
Okay, good. This is crazy. Again, I can only repeat myself. This is just a proof that you cannot put that into a mechanical fixed system. In order to trade stuff like that, you need your personal experience, those human factors that filter out good versus bad signals.
Around 45 R.
Just explaining this in a course like TJR is doing, okay, you do that, and then you do that, and then you do that, and then you will be profitable, obviously is not working.
The setups that are supposed to be the strongest are actually the weakest. Finally, Take Profit 3 was hit 16.7% of the time. This reinforces a key finding we discussed earlier, which strongly suggests that we can significantly improve results by applying a different take profit structure. So V2 is a disappointment, but it's informative. We start to find patterns that repeat across all versions, and these patterns are the real takeaway.
Again, I have to add something here. This is very, very, very obvious, okay? Now I'm gonna use this little space here to draw something. This is so obvious, guys. Let's say this is your entry and your stop loss is here and your take profit is all the way up here. Which is more likely to be hit? It's just a matter of probability, guys, in the overall markets. Of course, the trend and stuff always plays a role and maybe puts the probabilities a little bit in your favor. Okay, but at the end, it's just likely that even though if the market is starting, that we're gonna see a stop loss hit before maybe coming up to your take profit, because just it's like so much closer to your entry point. So the probability that this level will be reached, it's way more likely than this just because of distance. And in the end, the bias and the trending direction isn't making up for the big factor of distance.
Specific directions to make the strategy profitable and immediately improve our trading results.
And it's especially in Forex pairs, but I think is Forex pairs maybe not the right instrument for trying that out, because I think I did not watch a lot of TJR trading, but when I watched something, he was trading the ES, the NASDAQ, those big index instruments, okay? Because they trend a little more. A Forex pair is basically just going between prices, because the price of the euro compared to US dollar will probably not spike out of a specific range too much. So for those trend following strategies, maybe this is not the best instrument.
We only needed one final version to test, V2 plus the daily and weekly bias. This is the complete TJR framework. Liquidity sweep plus break of structure for the first impulse. Wait for a retracement to a significant level, with equilibrium working as a filter. Then only take the trade if the trend on the daily and weekly chart is aligned
I would not agree to this point.
with your trade. The final test. So let's run it. The complete version of TJR's test.
Again,
So let's run it.
if that is true and in 10 years it's only 3,800 trades, this is not a lot compared to all of the time frames he's looking at.
The complete version of TJR Strategy,
And in 4 pairs.
the one including all the core concepts he teaches, shows very negative results. Once again, the 15
This video it's so hard.
minute time frame is the clear winner, and Eurodollar is the worst currency pair. But the average return is minus 5.22%, and only 3 combinations out of 12 end up in profit. And let's not forget, we are testing optimized swing parameters and no
TJR has not an easy life in the last few months with all of those exposing that's being done of his business making money.
transaction costs. In real trading, with spreads, commissions, and slippage, these results would almost certainly be worse. So the data is clear about one thing. If you had traded this strategy over the past 10 years, you would have lost money and a lot of time. But this project was not worthless. Actually, it revealed something very important. The more we added to the strategy, the worse the results got. V1 averaged 20.13%. V1 with bias dropped to 7.85%.
Overcomplicating a strategy, guys, is a big problem. Make it as simple as possible and don't put too many filters and it will not make you better.
V2 dropped again to 4.23%.
Better rely on some experience that you will gain over time.
And V2 with bias finished at negative 5.22%. That is the opposite of what you've been taught. More filters did not create better trades. It made the strategy weaker. We open this video with one simple question. Does TJR strategy actually work? After 2 months of research, coding, testing, and interpreting the results, my answer is no. As a
I love it.
broad strategy, the performance is weak, especially relative to the amount of screen time and psychological stress required. But I want to be clear that this is not a personal attack on TJR.
Yeah, a little bit.
The goal of this channel is to test trading ideas, show what works, show what fails, and help you become a better trader.
So is my thought from the beginning just the better choice overall, just taking profit at TP1 in his version 1 strategy? Would that just be like the overall best choice that I immediately thought of? Okay.
TJR may trade with experience and discretion that are difficult to capture perfectly in code.
This is what I was talking about.
That is possible. But that is also exactly the point. If a strategy only works when the trader can constantly reinterpret the rules, then the edge is not in the strategy itself. So my conclusion is not TJR cannot trade. I don't know, and I'm not interested. My conclusion is the strategy, as taught publicly, did not work as a broad system.
Yeah, the strategy itself cannot be a mechanical system that you just follow every day in the same manner. This can be said. But in most cases, in almost every strategy that is being taught somewhere, the case. Because otherwise, if there would be a holy strategy that you can just follow step by step exactly the same way every day and will make you very, very profitable, this would probably not be taught publicly and will cost you several millions of dollars, okay? Because then this would be the holy grail. So don't expect a strategy that is being taught to you online that you can just follow mechanically every day and that will make you several $1,000s each week.
But I don't think the whole strategy is
Because if something is too good to be true, it probably is not true.
useless. Because inside the failure, we did find some interesting clues to work with. And so I started from there. I built a random forest model to identify what actually drives the strategy's profitability and what's just noise dragging it down. I rebuilt the take-profit structure based on what we found in the math earlier, and I expanded the asset base to include more directional markets like
stock indices. This is what he is trading basically a lot of times, isn't it?
gold, Bitcoin, and stock indices. Did it finally work? Did we find a smart money strategy that actually beats the market? One you can use in your own trading? The answer in the next video.
Ooh, I probably think there is some kind of simpler approach that will turn your profitability higher. Okay, thank you guys for watching. This video definitely deserves a like. If you haven't watched it, go to Revello Trading's channel and leave a like and a sub. I will do that immediately now. It's a lot of work that was put into this video. It deserves way more views than it already has. The average trading videos from TJR have 100,000 or 200,000 views. This one definitely deserves more. Thank you guys for watching. We're gonna see us in the next episode. That was a great watch. Good luck with trading this week. Leave a like and a sub to not miss out on future videos. And then we're gonna see us next time. Take care of yourself, guys. Bye bye.